Hi there, Stan the Annuity Man, America's annuity agent, licensed in all 50 states. I know before you even say a word, yes, this is crushed velvet, a crushed velvet Adidas sweatsuit, but don't be shocked because there's no Stan the Annuity Man logo, because if you know anything about logoing stuff, you can't logo crushed velvet. You know better than that, but hey, look right here, Annuity Man. Annuity Man rock and roll logo. So I'm all ready to go. Just calm down. It's going to be okay. You know why it's going to be okay? We're talking about annuity comparisons, QLACs, Qualified Longevity Annuity Contracts, versus DIAs, Deferred Income Annuities. We're going to compare them. We're going to talk about how they differ, how they're the same, all that stuff, why you should look at them, why you shouldn't look at them. In other words, the brutal facts, because as you know, I'm the walking middle finger of annuity truth that just happens to be wearing a crushed velvet sweatsuit and getting ready to listen to a song that I wrote as I flew in to jam with U2 in Ireland, because Bono is my homeboy, as you know. Hit the music. All right, we're back. Don't focus on the crushed velvet. I know what you're saying. Crushed velvet? Really? They make that? Yes, they do. But what we're talking about is not crushed velvet. We're talking about retirement insurance, income insurance. That's what annuities provide, lifetime income guarantees. You got car insurance, you got home insurance, you got fire insurance, you got dental insurance, you got health insurance. Guess what you need? Income insurance, retirement income insurance. And that's what annuities can provide. So what we're talking about today, qualified longevity annuity contracts and deferred income annuities. It all starts with deferred income annuities. Why? Because a qualified longevity annuity contract is a deferred income annuity. But qualified longevity annuity contracts can only be used in qualified accounts, i.e. qualified longevity annuity contracts. Those were put on the planet in 2014, actually the newest type of annuity, and it was introduced by our friends at the IRS and our friends at the Department of the Treasury because they wanted retirees to start planning for income using their traditional IRA assets. There's trillions and trillions and trillions and trillions and trillions of dollars in IRAs, and the government's just always looking at salivating going, IRA assets. How do we get to those? That's come on, there's so much money. That's what they're saying, but they're saying a little bit better, but they're that emotional. But what they want people to do is plan for future income, because Social Security, which, oh, by the way, is the best inflation annuity on the planet that all of you own that have a Social Security number. So all you annuity haters, you already own an annuity, so calm down a little bit. I know that's a shock. But qualified longevity annuity contracts, the government's saying, tap us on the shoulder. Can you use the IRA assets for future income? Could you do that for us and maybe take a little bit of the load away from Social Security? That's really what a qualified longevity annuity contract is all about. Now, I have written books on all these topics: qualified longevity annuity contracts, deferred income annuities. If you go to my site at theannuityman.com and sign up for the books, I will send you my 6 owner's manuals, and 2 of those 6 will be qualified longevity annuity contract owner's manual and DIA owner's manual as well. So those can really help. In addition, if you go to the playlist underneath me here, you see playlist, click that, you'll see a lot of videos I've done on QLACs, a lot of videos I've done on DIAs. But qualified longevity annuity contracts at the time of this taping, that's key. At the time of this taping, you can put in up to $135,000 in your personal IRA using money in your IRA to fund a QLAC. The actual rule is 25% of your total IRA assets, or $135,000, whichever's less at the time of this taping. Hopefully they raise it. Hopefully you're watching this 3 years from now going, no, that is 150. But at the time of this taping, it's $135,000. Now the rules are you can defer as far out as age 85, but you don't have to go that far. A lot of people go, well, I don't want to defer my QLAC to age 85. You don't have to, okay? But that's when the IRS and the Department of the Treasury says you've got to turn on the income. Now here's the good news about QLACs, all right? Number 1, you can add your spouse or partner for joint lifetime income using your personal and traditional IRA. That's a good thing. The other thing that I think is a positive is that let's just say you qualify for the $135,000 that you can put into a QLAC. That $135,000 is not used when you go to take your required minimum distributions at the time of this taping. That's age 72. They're thinking about raising it, but at the time of this taping is 72. So when you go to factor in your RMDs and you're adding up all your assets, that 135 in a QLAC is not part of that required minimum distribution. But when you turn on that income stream for the QLAC, that income stream amount fully satisfies that amount in the QLAC. Okay, so QLACs are great. In a perfect world, I think they might be the top selling annuity type on the planet. The reason it probably will never happen is that annuity agents, a lot of annuity agents and RIAs and advisors don't even know what a QLAC is. I was brought in recently to I won't name the firm, but a large bank, one of the top 5 banks, to talk to their advisors and to explain to them what a QLAC was, because they needed to, their clients needed to know about it. In my opinion, if you have a traditional IRA, you need to be quoting a QLAC, because to me, it's a future income stream that can combat against potential and future inflation. It's a no-brainer, and set up with your spouse or partner, it's a lifetime income stream that neither of you can outlive. As long as you're breathing, as long as you're doing that, you're going to get the payment. It's a transfer of risk, lifetime income insurance, right? Lifetime income insurance that the annuity company's on the hook to pay as long as you're breathing. But a QLAC is a deferred income annuity. Deferred income annuities were on the planet before QLACs. QLAC is just a version of a deferred income annuity, and it has those limitations. You can use it has to be used in a qualified account, has premium limitations, etc. But a deferred income annuity, no limitations. You can use it in an IRA, a Roth IRA, and a non-qualified account. Now, in an IRA, most carriers will not allow you to run a quote that has income starting past age 72 with a deferred income annuity. There's no limitation. There's no $135,000 limitation with a deferred income annuity inside of an IRA with income starting before age 72. You can put as much as you want. Okay, you can go to the site, my site, theannuityman.com, and run quotes and put in as much as you want. You can run a lump sum, or you can run a reverse engineer quote, meaning I want to have $2,200 of income start in 7 years, and I'm age 62 using my IRA assets, so it starts at age 69, and we will quote all carriers to find the top carriers that you can use the least amount of money to solve for that contractual amount. Now, both QLACs and deferred income annuities, no annual fees, no moving parts, no market attachments. It's a straight transfer of risk for future income. Deferred income annuities, in essence, it comes from the immediate annuity. They're all, if you want the family of annuities for lifetime income, immediate annuity, deferred income annuity, QLAC, all the same structure, no annual fees, no moving parts, no market attachments. Deferred income annuities really an immediate annuity becomes a deferred income annuity once you defer past that 1 year time period. But really, these are great transfer risk pension products. And you can structure them a myriad of ways. You could structure them life only, or life with cash refund, or life with installment refund, or life with period certain. You could, if you want a customized quote, I would encourage you to go to my site at theannuityman.com, and let's have a conversation about what do you want the money to contractually do, when do you want those contractual guarantees to start. Those are the 2 questions I always ask, and then I will run customized quotes quoting all carriers, and we'll use DIAs, we'll use QLACs, whatever you answer, I'm going to take that answer and say, okay, this is what we need to do, with the IRA asset or non-IRA asset or Roth IRA assets, whatever you want to use from an account standpoint. But I like both of these. Both deferred income annuities and qualified longevity annuity contracts are simple. You can explain it to a 9-year-old, no offense to 9-year-olds. It's easy to understand. It's a pension, and living in a pensionless world where 10,000 baby boomers are hitting age 65 every single day, and a lot of you and them and us don't have pensions. This is how we create pensions. This is how we know what the income is going to be in the future with deferred income annuities and qualified longevity annuity contracts. Once again, I encourage you to go to my site, run quotes on them yourself, schedule a call with me if you want to discuss, get the books on them as well. I'm trying to educate out here. Are these too good to be true? No. But you know what is too good to be true? And know what is a fact? Actually, it's not too good to be true. It's a fact. The fact is lifetime income is good. Lifetime income insurance is good. Retirement income insurance is good. The question is, do you need that? Do you need more? Do you need to fill in that income floor? With most of us, the answer is yes, and I hope that we talk soon. And with that, hit the subscribe button, share, like, and comment, and I'll see you on the next Stan the Annuity Man YouTube video.